Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's just dive right in. We're looking at the extreme capital degradation we've seen at Northern Corp, ticker NCL. And this isn't some gradual slide. We're talking about a stock that by late December 2025 was trading between, 17 and 26 cents. It's a catastrophic price collapse, an 83% loss of value since the 1-for-8 reverse split they did just 2 months back in October.
And the most obvious catalyst, the thing that really kicked off this final descent, was that corporate action in mid-December. The issuance of just a huge block of 3.3 million shares for advisory services. It was a massive, sudden supply shock into what was already a very, very weak structure.
Exactly. And this corporate desperation, it really forces our central question today. Is NCL's failure, is it fundamentally a result of, critical financial deterioration and a necessary, if brutally dilutive financing strategy? Or, and this is the other side, is the sheer velocity of this collapse really a product of opaque market dynamics, specifically dark pool selling? I'm going to argue that the poor fundamentals coupled with managerial desperation are really the root cause here. This was inevitable.
And I'll present the case that while the fundamentals are, they're abysmal, let's be honest, the actual structure of the fragmented off-exchange market is what really facilitated and amplified the speed and depth of this value destruction. I mean, the market mechanism was basically the bullet train that drove this thing straight to zero.
When you really analyze the trajectory of Northern, the collapse we've seen it's nothing more than a rational market response to an unavoidable reality. The company's inability to fund itself is the primary driver, not some, malice in the market's mechanism. To get the scale of the crisis, you have to look at the Q 2025 financials. Revenue fell a sharp 16.56%. That's a failing business. But the really damning part, the net loss widened by a staggering 302%, hitting negative $17.63 million. That burn rate isn't just unsustainable, it's existential.
I accept those numbers. They absolutely define the crisis.
And this financial black hole directly explains what happened next. That issuance of 3.3 million shares in December wasn't a strategic choice. It was driven by an immediate existential cash crisis. I mean, at one point, the company had an ending cash balance of just $0.04 million. That's $40,000. When management is facing that, they have to pay advisors like Lincoln Investments with big blocks of equity. And that's where the toxicity really starts. This equity creates an immediate and massive supply overhang because the recipients have a zero-cost basis. To be clear for everyone listening, a zero-cost basis means they got the shares essentially for free in exchange for services. So any price they sell at, even 17 cents, is pure profit. They are guaranteed to liquidate, and that relentless selling pressure is something no equity market, I don't care how transparent or fragmented it is, can withstand long-term. This is a corporate decision ensuring supply, not a market failure.
I struggled to accept that the inevitability of selling justifies the rate of the collapse. I don't dispute the financial distress. The company is, by all metrics, failing. But the issue isn't that the shares are being sold, it's how and where they're being sold. The market structure allows the stock to collapse with an extraordinary efficiency, and that efficiency, it borders on institutional facilitation.
But efficiency is often just the market reacting quickly to mismanagement.
But the reaction is happening entirely in the dark, and it's bypassing essential price discovery. Let's look at the metrics for off-exchange trading for NCL in late 2025. The off-exchange short volume ratio exceeded 55%, so more than half of all the trading volume is happening away from the public, or lit exchanges, where visible bids and offers should be setting the price.
But why does the venue matter if the supply is guaranteed to be liquidated anyway?
Because it speaks directly to this liquidity paradox that we see in the data. We saw a massive total short volume, something like 23 million shares traded short in December. And yet the actual open short interest, the directional bets that haven't been covered, was negligible, around 104,000 shares. That's a 220 times difference. This huge disparity confirms that most of this isn't directional short selling. It's high-frequency market makers using dark pools to absorb the massive supply from those new advisory shares. They short the stop as a technical mechanism to immediately cover buy orders and just distribute the dilution shares, bypassing the lit exchange entirely. This off-exchange execution just suppresses any meaningful price discovery. The heavy supply pressure drives the price down without ever building visible order walls on the public exchange that might attract, some stabilizing capital looking for a bottom. The structure turns guaranteed selling into maximum price destruction.
See, I fundamentally diverge on the primary cause. The market is reacting logically to a deeply destructive pattern of behavior from the company. This isn't just about the 3.3 million shares in December 2025. The root cause is the company's repeated decision to issue shares to the same advisor, Lincoln Investment and others. We saw 3 million shares issued in December 2024, another 1.8 million earlier in 2025, and then this latest round.
And 1.5 million to Lu Wang at the same time, right? So that's 3.3 million shares hitting the market almost at once.
Precisely. This pattern is a textbook financing death spiral. The corporate mechanism is designed to transfer value slowly and painfully from public shareholders to service providers. When the business can't generate cash, its only lifeline is to pay debts in deeply discounted equity, which is immediately liquidated, which forces the price lower, which then requires even more shares for the next round of payments. You can't blame the plumbing when the company's left the tap on full blast with sewage pouring out.
That's a compelling point on corporate intent, but we have to focus on the sheer volume and velocity. That 23 million share figure in off-exchange shorting, it proves the structure is facilitating the collapse with unnatural speed. If that 3.3 million shares of zero-cost supply were forced onto the lit exchange, it would have either triggered circuit breakers or maybe momentarily found institutional buyers who could see the order book. Instead, the dark pool mechanism facilitates this high-velocity distribution, a churning of volume while masking the real selling pressure. That specific dynamic is why we saw an 83% erosion post-split, not a more gradual, say, 40% decline that might have allowed for a correction.
I'd argue that even on the lit exchange, the desperation in the financials, that 302% increase in losses, would have scared off any stabilizing money anyway. When the numbers show a terminal illness, visibility just confirms the diagnosis faster.
Okay, let's pivot to the failure of the capital restructuring, the October 2025 1-for-8 reverse split. That was management's attempt to cure the NYSE American compliance issue. Trading below $1. That action failed almost immediately.
Right. It signaled the end, not the beginning of stability. It just proved the market was right to treat it like a failing entity.
But the failure was amplified by technical vulnerabilities in the market's plumbing. The data shows the stock was technically stressed. Short shares availability fluctuated wildly, including dropping to 0 shares available on December 24th. The stock was hard to borrow, and that status should, counterintuitively, deter directional shorts. It should create a technical floor.
I'm just not convinced by that, because the hard-to-borrow status becomes completely irrelevant when the company itself is the supplier of new shares. The stock is only hard to borrow for someone who wants to take a leveraged short position. But if Lincoln Investment is just granted 3.3 million zero-cost newly created shares, they don't need to borrow them. They're selling primary shares directly into the market. They completely circumvent that technical constraint.
That is the critical intersection. The technical stress creates a vulnerability that only these dilution shares can exploit. The structural difficulty in borrowing means that the only sustained selling pressure that can exist is this zero-cost dilution selling. And that selling, when funneled through dark pools, is devastating because there's no normal mechanism to absorb it. The structure is almost perfectly set up to facilitate the rapid liquidation of unconstrained zero-cost supply.
My point is that the split itself was the fatal corporate signal that started this final stage. Reverse splits, NCL, had a history with that 1-for-2 pre-IPO split in 2023. They are inherently destructive signals. They scream that management can't fund operations organically. The retail base, even while struggling with the cruise line ticker confusion, correctly identified this desperation. We saw garbage and scam narratives emerging right after the split, leading to just total capitulation from anyone who might have otherwise held on.
And that brings us right to sentiment distortion, which is a huge factor here.
The signal-to-noise ratio is completely shot, driven by the confusion between NCL, Northon, and NCLH, the Norwegian cruise line. Algorithms pick up thousands of irrelevant discussions about cruise ships. And this completely masks the reality that the genuine sentiment for Northon, the actual company, is overwhelmingly negative. It's despair, skepticism, allegations of a dilution trap. This lack of genuine retail engagement just removes any potential floor for the stock that we've seen in other microcaps.
I come at it from a different angle. While that sentiment distortion is real, the institutional selling from these dilution deals is so powerful and so technically efficient that even a coordinated retail army would have been useless. Let's just quantify that again. The price is being set by institutional liquidity providers, absorbing advisory sales through dark pools at a 55% off exchange rate. Retail sentiment, positive, negative, it's irrelevant when you're facing a structured supply shock of 3.3 million shares hitting a microcap with a tiny $5.9 million market cap. The supply is institutional, the distribution is opaque, and the outcome is pre-programmed collapse.
But you're arguing the market structure has achieved this perverse stability where it just absorbs toxic corporate actions, passing the cost entirely to public shareholders. You still haven't convinced me the structure is the primary cause, only that it's an amplifier. The company created the shares. Therefore, the corporate failure is the core driver. You can't have market abuse without the underlying stock to abuse.
And I maintain the structure provides the means for a high-velocity collapse. The 83% drop in 2 months is evidence of that unnatural speed. If any microcap, profitable or not, pays advisors with 3.3 million zero-cost shares, that supply shock is maximized for destruction by this market structure. The dark pools provide the rapid pipeline needed to liquidate that equity with maximal price impact and minimal visibility. The fundamentals provided the desperation, but the market structure provided the hyper-efficient kill mechanism.
I still believe you can't logically separate the two. The crisis is fundamentally financial and managerial. The company's $17.63 million net loss, the 302% increase in losses, and the repeated decision to fund operations by flooding the market with zero-cost shares. That all made the 83% collapse an absolute certainty, no matter the trading venue. The corporate actions initiated and fueled the death spiral.
And I believe the market structure is the active enabler of the collapse's extreme speed and depth. That massive flow of shares from dilution is only so destructive because the 55% off-exchange execution allows that extraordinary short volume 220 times higher than open interest to happen opaquely. This structural opacity prevents any stabilizing price discovery, turning what should have been a slow death into a high-velocity capital degradation event.
I think ultimately the Northern case study demands a synthetic view. It's one that demonstrates exactly how aggressive corporate financing tactics, which are driven by fundamental failure, interact with an opaque market structure to create this uniquely destructive environment.
Exactly. It just proves that fundamental collapse and detrimental market mechanics are often synergistic forces in the rapid degradation of microcap equity, leaving investors caught between a failing balance sheet and a fragmented trading venue that just maximizes their pain.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.